Hello viewers, welcome to my channel. After having done a first video reviewing the trades or the trading video lessons from a guy called ICT, I noticed that I had a lot of viewers, and I thought, well, maybe they might be interested to, or you as a viewer may be interested to hear a few more things just about general aspects of trading, which I wanted to talk about, but I'm certainly not in the league of those professional traders like ICT that are making millions, and I'm just a small trader. I've lost more money than I've made, so I'm not here to give investment advice or anything at all. I just talk about a few important things in risk management that I hope will be helpful, especially for beginners. So here we go. Just want to talk about two things. One of them is something called R, the R number associated with the trade, and then I'll show another example where how to use R when you do multiple lots. So this is just a first lesson I wanted to give. I picked up R from a book, I think by Elder, on trade management or psychology or something like that. And basically there's about 3 books that impressed me in trading. One of them was by Edwin Lefebvre, Reminiscences of a Stock Operator, which kind of resonated with me, and I just sort of thought I could be that person, but obviously after 30 years I'm not. Another one was a book by Larry Williams, How to Make $1 Million or something in Trading, and gee, there were a lot of great things in there. And interestingly enough, the guy I reviewed in the first video, Michael something from ICT, he also has a great respect for this Larry Williams character. Okay, so having said all that, let's talk about R and what it is and how to do it properly. So where's the chart here? Came up with a couple of examples just for the sake of interest. I picked up a futures contract here. I could have done futures or I could have done Forex. The concept is all the same, just different point values or pip values, but apart from that, the same concepts apply to everything. So there's a thing called the NASDAQ March 2022 contract, and I've got it open on TradingView. I've got a daily chart shown on the left where each candle represents 1 day, and I have a 5-minute chart on the right where each candle represents 5 minutes. Now, the trader on the left makes a trade on the daily chart and maybe gets in here and gets out there. And the trader on the right makes a trade on the 5-minute chart and maybe gets in here and gets out there, and the stops are also shown. So I took all those numbers and put them into a spreadsheet, which is this one. Here we go. Okay, so this is the numbers. If we look at, just to confirm, trader A bought at 14.152, closed the trade out or sold at 14.833, stopped there. So you might look at those two trades and think to yourself, well, which one is the better trade, the one on the left or the one on the right? So then, as a beginner, and I'm pretty much addressing this to beginners because the more experienced traders here will know all these things. So as a beginner, you think, well, this guy, let's see, he made 681 points. So if you subtract, the blue one from the red one, you get the point value, 681 points, and some people call that handles, but I just call it points because it's a point. A point is worth $20 in the NASDAQ contract. So that person, if they did one contract, they made $13,000 something. How much did they risk? Well, the risk is that minus that is 533 points, which is $10,000. And just to sort of make a bit of sense out of it all, let's say that you've got a $500,000 account, and I'm sorry for the beginners, I should have used a smaller number, but if we were using a smaller number, then I would have to switch over to the micro NASDAQ contract called MNQ. But let's just stick with NQ for teaching's sake. And then, of course, if you're a trader with a small account, you'd probably gravitate toward the MNQ account. So, okay, so this guy or girl has taken one lot. Why one lot? Well, it's sort of the ratio of you've got $15,000 and you've got 11,000 of risk. You can get about 1.4 lots in there, but because we can't use, you have to just have whole integer numbers, so 1.4 lots becomes 1 lot. And the guy on the right, or the girl on the right, whoever it is, also risks 3%. They've also got the same account size, and they only make 116 points as opposed to 681 points. On the other hand, their risk is only 41 points as opposed to 500 points. So we can come up with a thing called the R on the trade, which is just the ratio of the reward to the risk. So just as simple as that, divided the red divided into the blue. So this first person got an R of 1.3 and the second one got an R of 2.8. And then the second one, in terms of lots, well, if they've got $15,000 to play with, and one lot is worth $820, then they're allowed 18 and a bit lots, which rounds down to 18 lots. Okay, so in essence, with the same putting 3% into the trade, then actually the one on the right makes more money. And you don't have to, and I put in the commissions too. I've assumed it's like $5 a lot, and there are 18 lots here, so that's where the $90 comes from, whereas here it's only one contract, so $5. Okay, so really all you have to do is look at the R number for the trade, and so I just wanted to define the R number as the ratio of reward over risk. It's also called the reward to risk ratio. Some people somehow or other call it risk to reward, but it's actually reward divided by risk. Okay, so if you want to know which trade is better, in my book, 2.8 is better than 1.3, so just look at the R number. So that's why the R is useful in analysis. Having said that, however, I don't want you to think that you should go into a trade with a mindset of saying, I want to get an R of 6 or an R of 3. You basically have got to go into a trade and get whatever the market's going to give you out of it. I don't know, if you're coming short down here, you'd want to get all that. If that happens to be an R of 3 or 4, you take it. You don't argue with the market. So anyway, at the end of use of all that, that gives you a way of analysing the trade. And the R value by itself is not the only thing, because the R value tells you what you made on the trade compared to what you risked. But there's also another thing called the win rate. So if you do 50 trades in a row, 50 trades and you lose 20 and you win 30, then a person who does a higher win rate can get away with a lower R value to still be profitable. You just have to multiply the two things together. That'll be for another topic. So R is just a piece of analysis. So you just use it for that purpose and don't get carried away with R. Don't try to aim for a 5R trade. There's nothing wrong with a 1R trade or a 0.5R trade if you're a scalper, as long as your win rate is sufficiently high to be compatible with that. Now the next thing is it's good to use the correct definition of R with multiple lots. So I've been in this sort of trading industry for 30 years, and I've seen all sorts of traders come and go. Where did that window go? Something's not right here. Oh, okay. Here we go. Sorry about that. And sorry, somewhere here. I think it's this one. It is. Oh yeah. Sorry about that. All right, here we go. So I've come across some strange definitions in strange places, not in any particular context. Of it might be some system I bought 15 years ago or something from somebody that you've never even heard of. But not everybody really understands the R value in the right way. So I just wanted to clearly define it here. So here's another example of a trade where somebody bought in here and then with 2 lots, and then they put their stop on both lots down here, which is 227 points away. And then they said, look, I don't know if I can get 1, 2 or 3 or 4 or 5R out of this, but what I'll do is I'll take 1R, cover off the risk, and then let the other one run. And then they got 1R on the first lot, and they got like about a 2 or 3R. They got out here and at that price there on the second lot. So then you say, what's the R for this trade? Okay, well, you just got to calculate it. It's straightforward. Example 2. Okay, so you bought 2 at 14,470. Let's just push this a bit over there. Shrink that up a bit, and bring that back. Okay. 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 There we go. So you buy 2 lots at 14,470 and your stop on both lots is 14,243. Your first target is 14,697 up here. Your second target is 15,165 up there. All right. So on your first profit is that minus that is 227 points. And on the second one, you made 3 times more. So, and then if you want to get the sort of dollar value, you just say that's one lot, $20 a point, multiplied by the number of points. Right? So, some people I saw, and this was a long time ago, and it's probably not anybody you know, someone else, but there was someone who was saying, oh, well, I got, on the second lot, I got 3 to 1, so therefore my R is 3 to 1. Well, it's not. So if someone says they got 3 on that, their understanding of mathematics is poor. Okay, so the way to calculate R is just simply the total reward over the total risk. So the total reward is this number here, which is the sum of these two dollar values, okay? So you made that plus that, which is 18 grand. And then how much did you risk? Well, your risk is this one here, 227. You must have risked 4 grand per lot on that. So, and then if you multiply that by that 2 lots, then your risk is, your risk is 9,000. So you made 18,000 and you risked 9,000. So you made an R on that trade, 2, which if you think about, if they were just 2 separate trades on a lot each, then one of them would have been an R equals 1, one would have been an R equals 3, and the average of 1 and 3 divided by 2 is 2. So that's the R for the composite position. So module 1 was that, module 2 was that. So just wanted to help you with this R, because once you have an account and you start looking at the R value of each trade in the context of analysis of the performance of your account, the smoothness of the equity curve, in all those things, it's good to start off with the right definition. So that's what I've tried to do today. Hope that's a bit of help. If anyone has any comments, please leave them below. And if people are interested, I can do another talk maybe on psychology in trading. All right, that's probably where I'll stop. Thanks for your attention. Goodbye.